Let's look at some basic guidelines for the control of cash. 1. Do not permit any one employee to handle a transaction from beginning to end. 2. Separate cash handling from record keeping. 3. Centralize receiving of cash to the extent practical. 4. Use cash registers and electronic point of sale systems. 5. Record cash receipts on a timely basis. 6. Encourage customers to obtain receipts and observe cash register totals. 7. Deposit cash receipts daily. 8. Make all disbursements by check or electronic funds transfer with the exception of small expenditures from petty cash. 9. Have monthly bank reconciliations prepared by employees not responsible for the issuance of checks or the custody of cash. The completed reconciliation should be reviewed promptly by an appropriate official. 10. Mail monthly statements to customers. 11. Monitor cash receipts and disbursements by comparing recorded amounts to budgeted forecasted amounts. And 12. Use a direct receipt of funds by a financial institution system such as Lockbox. Here are some additional internal control procedures over cash disbursements. Segregate duties. Pay by check or electronic funds transfer. Use a pre-numbered check. Match the purchase order and receiving documents with the vendor's invoice. I like to see all three matched before the transaction is recorded for payment. Review supporting documents by the authorized check signer. Cancel the supporting documents. Simply mark them paid. The authorized check signer should mail the checks. They should not be returned to the preparer. And of course, prepare a monthly bank reconciliation. Here are the typical substantive procedures for cash transactions and balances. Remember, these are the audit tests we do to substantiate the account balance. 1. Obtain an analysis of cash balances and reconcile them to the general ledger. 2. Confirm cash balances with financial institutions. 3. Obtain or prepare reconciliations of the bank accounts as of the balance sheet date and consider the need to reconcile bank activity for additional months. 4. Obtain a cut-off bank statement containing transactions of at least 7 business days subsequent to the balance sheet. 5. Count and list cash on hand. 6. Verify the client's cutoff of cash receipts and cash disbursements. 7. Analyze bank transfers for the last week of the audit year and the first week of the following year. 8. Investigate any checks representing large or unusual payments to related parties. And 9. Evaluate the proper financial statement presentation and disclosure of cash. Here is a summary of the substantive audit procedures for cash. As mentioned previously in the course, our primary audit objective is to determine that management's assertions, existence, completeness, cutoff, presentation, etc., relating to cash are not materially misstated. See the primary audit objectives. We need to determine that the balance in the cash account is real, it exists, it's complete, we got everything, transactions occurred, were accurate, we have the right to the cash, We achieved a proper cutoff for December 31st client. We make sure January transactions are not part of cash. Cash is presented properly, current asset on the balance sheet, and that appropriate disclosures about cash have been made in the footnotes. When internal control over cash is weak, the auditors may prepare a proof of cash. This technique may cover the entire year under audit and is used to identify cash receipts and disbursements recorded in the accounting records but not on the bank statement. Cash receipts and disbursements recorded on the bank statement but not in the accounting records. And cash receipts and disbursements recorded at different amounts by the bank than in the accounting records. In essence, we tie in the bank to the accounting records. Here is an example. Per the bank statements, we get the balance from the beginning of the year and the end of the year. Then I get the total disbursements and deposits from the statements. 12,000 minus 4,200 plus 6,400 equals 9,800. We do the same thing for the general ledger. Beginning cash was 11,620 minus disbursements of 5,000 plus receipts of 7,100 equals our ending general ledger cash balance of 9,520. We obtain the totals for outstanding checks and deposits in transit from last year's bank reconciliation and the current year's bank reconciliation. We then add up all the columns as shown, and if everything has been recorded properly, we should be in balance. We have tied in the bank records to the client records for the entire year. Lapping is the concealment of a cash embezzlement by delaying the recording of cash receipts. As shown on this slide, customer Abbott pays $250 and Brown pays $1,025 on December 1st. The bookkeeper steals the $250 payment from Abbott and deposits the $1,025 payment into the bank. The next day, Crane pays $250 on his account and Delton pays $500. The bookkeeper uses the $250 payment from Crane and credits it to Abbott. But now Crane is short $250. The next day, Eckert makes a $1,200 payment and Ford makes a $400 payment. The bookkeeper uses $250 from the Eckert payment to credit Crane. But now Eckert is short $250. The bookkeeper must take $250 from a future payment in order to credit Eckert the full $1,200. This fraud usually happens when the duties of the cashier and accounts receivable bookkeeper are not segregated. As you can see, a lapping scheme quickly gets complicated. Often, the scheme becomes so complicated that it collapses as the bookkeeper no longer knows who to credit what amount to. The auditor is concerned about transfers between bank accounts at year-end because they could be covering up a kiting scheme. Kiting is a general term applied to using the float associated with cashing and depositing checks. This manipulation can be used to cover up a fraud or meet short-term cash needs. When a check drawn on one bank is deposited into another bank, several days called the float period may pass before the check clears the bank upon which it is drawn. Using this float period to manipulate account balance is known as kiting. Electronic processing has made kiting more difficult by reducing or eliminating the fraud period. Here is an example of kiting used to conceal a fraud. Let's assume the company has two accounts. On December 13, bookkeeper John Jones writes check number 12 from the state bank account to himself for $10,000 and cashes it. The check is not recorded in the company records but will clear the bank. The problem is that Jones must cover up the shortage when the auditor examines the bank account at year-end December 31st. To cover up the shortage on December 31st, Jones writes check 28, transferring $10,000 from the national account to the state account. On December 31st, he takes the check to State Bank and deposits it. He records the check on January 1st in the books. Thus, it shows up as a deposit on the state bank statement, but Jones does not record it as a deposit in the bank accounts on the company books until January 1st. In essence, he has temporarily covered the shortage, so on December 31st, the audit date, everything looks okay to the auditor. Bank transfers are analyzed by the auditor to disclose overstatements of cash balances due to kiting. Auditors can detect manipulations of this type by preparing a schedule showing all bank transfers a few days before and a few days after the balance sheet date. Here is an example based on the previous slide showing kiting. Notice that check 28 in the transfer schedule was not recorded in the books as a receipt. This transaction is a red flag for the auditor.